Turning to the third vulnerability, which is excessive debt loads at households and businesses. Credit booms have often led to credit busts and sometimes to painful economic downturns. When the bust comes, those who have overborrowed tend to sharply reduce their spending. Defaults typically rise faster than expected, which may put financial institutions into distress. And these effects may combine to bring a serious economic downturn. This boom-bust pattern was clear in measures of household debt around the crisis period, with mortgage debt rising far above its historical trend and then contracting sharply. After the contraction, though, household debt has grown only moderately. The net increase in mortgage debt has been among borrowers with higher credit scores. So while heavily indebted households will always suffer in a downturn, put all this together and it suggests that household debt would not present a systemic stability threat if the economy sours. Non-financial business borrowing presents a subtler story. With corporate debt, the U.S. has not faced a massive credit boom like that experienced with residential mortgages before the recent crisis. Instead, after controlling for its trend, business borrowing relative to GDP has generally risen during expansions, no doubt reflecting business optimism, and then it has fallen when the cycle has turned, as some of that optimism has proven unfounded. By this measure, the ratio of corporate debt to GDP is about where one might expect after nearly a decade of economic expansion. It's well above its trend, but not yet at the peaks hit in the late 1980s or late 1990s. Further, the upward trend in recent years appears broadly consistent with growth in business assets relative to GDP. There are, however, reasons for concern. Information on individual firms reveals that over the past year, firms with high leverage and interest burdens have been increasing their debt loads the most. In addition, other measures of underwriting quality have deteriorated and leverage multiples have moved up. Some of these highly leveraged borrowers would surely face distress if the economy turned down, leading investors to take higher than expected losses, developments that could exacerbate that downturn. The question for financial stability is whether elevated business bankruptcies and outsized losses would risk undermining the ability of the financial system to perform its critical functions on behalf of businesses and households. For now, my view is that such losses are unlikely to pose a threat to the safety and soundness of the institutions at the core of the system, and instead are likely to fall on investors in vehicles like CLOs with stable funding and less threat of a damaging fire sale. Of course, we will continue to monitor developments in this sector carefully. The fourth and final vulnerability arises when asset values rise far above conventional, historically observed valuation benchmarks, a phenomenon popularly referred to as a bubble. The contentious term bubble, however, does not appear in our work. Instead, we focus on the extent to which an asset's price is high or low relative to conventional benchmarks based on expected payoffs and current economic conditions. Historically, when asset prices soar far above standard benchmarks, sharp declines follow with some regularity, and those declines may bring economic misery reaching far beyond investors who are directly involved in the speculative activity. We therefore pay close attention when valuations get to the extreme ends of what we've seen in history. Looking across the landscape of major asset classes today, we see some classes for which valuations seem high relative to history. For example, even after standard adjustments for economic conditions, valuations on riskier forms of corporate debt and commercial properties are in the upper ends of their post-crisis distributions, although they're short of the levels they hit in the pre-crisis credit boom. We see no major asset class, however, where valuations appear far in excess of standard benchmarks, as some did, for example, in the late 1990s dot-com boom or in the pre-crisis credit boom. The asset class that gets the most attention today is, of course, the stock market. And today, equity prices are broadly consistent with historical benchmarks, such as forward price-to-earnings ratios. It's important to distinguish between financial market volatility and events that threaten financial stability. Large, sustained declines in equity prices can put downward pressure on spending and on confidence. From a financial stability perspective, however, today we do not see dangerous excesses in the stock market.